Welcome to episode 11 of Nova Bourse US. Today, we are diving into the art of valuation ratios. When you hear that a stock is either expensive or cheap, the answer to that mystery does not live in the price tag itself, but in the ratio. Throughout this season on fundamental analysis, we have been building your toolkit, and today is where we learn how to measure price against actual value. We have an agenda packed with 5 essential metrics that will help you move beyond surface-level observations. Let's get started. To understand why ratios matter, consider the lesson of Cisco Systems. In March 2000, Cisco peaked with a market cap above $500 billion and a price-to-earnings ratio of approximately 201. Investors were essentially paying $201 for every $1 of earnings, betting the internet revolution would never slow. While Cisco's revenues did grow fourfold over the next 2 decades and profits quintupled, the stock collapsed 80% in 2 years and took 21 years to reclaim its peak. The business was fine, but the valuation ratio was the problem. This episode is designed to give you 5 specific tools so you can avoid paying those kinds of Cisco prices. The first thing you must learn is that price alone tells you nothing. A stock trading at $10 per share can be expensive, while a stock at $1,000 can be cheap. The difference is what you get for what you pay. For example, a single share of Berkshire Hathaway Class A stock trades near $740,000, yet its price-to-earnings ratio sits below 15, which is actually below the S&P 500 average. Meanwhile, a penny stock with no earnings has an infinite price-to-earnings ratio and no mathematical floor. Valuation ratios normalize price against fundamentals, like earnings, growth, cash flow, or book value, making comparisons meaningful across companies, sectors, and time. The price-to-earnings ratio is the most widely cited metric in finance. You calculate it by dividing the stock price by earnings per share over the trailing 12 months. The result tells you exactly how many dollars investors pay for $1 of reported profit. As of mid-2026, the S&P 500 trades at a price-to-earnings ratio near 26 using trailing operating earnings, which is roughly 31% above its long-term average of 19.8 since 1989. Historically, when the market ratio sits above 25, forward returns over the next decade are typically below average. But when it falls below 15, they have historically been quite strong. Let's look at a concrete example: Apple. Its trailing price-to-earnings ratio stands near 38 as of mid-2026, which is 53% above its 10-year historical mean of roughly 25. Its 5-year average is approximately 30.7, meaning the current multiple exceeds even the recent elevated norm. With earnings per share at $8.27 against a stock price near $315, the market is pricing Apple more like a recurring revenue platform than a simple electronics company. Whether that re-rating is justified depends on whether services revenue and artificial intelligence monetization can sustain margins above 26%. The ratio doesn't answer that, but it quantifies the bet. Sometimes this ratio fails entirely, as seen with Amazon for most of the 2010s. Its ratio stayed above 100, and at times it even went negative. The stock wasn't overvalued. The metric was measuring the wrong thing. Jeff Bezos was deliberately reinvesting every dollar of operating cash flow into infrastructure and expansion, suppressing net income by design. Amazon's operating income grew from $13 billion in 2022 to roughly $80 billion by 2025, while margins expanded from 2.6% to 11.2%. Today, Amazon's ratio has compressed to between 29 and 34. A high ratio can signal overvaluation, a broken model, or a deliberate choice to sacrifice earnings for growth. So far, we have looked at the past, but the forward price-to-earnings ratio looks at the market's prediction. This divides the current price by analyst consensus earnings estimates for the next 12 months. The gap between trailing and forward numbers reveals growth expectations. For instance, Meta Platforms trades at a trailing ratio near 22 but a forward ratio near 19, implying analysts expect roughly 16% earnings growth. NVIDIA's forward ratio of approximately 23 sits well below its trailing ratio of 31, reflecting consensus that earnings will keep rising rapidly as infrastructure spending continues. When the forward ratio is significantly lower than the trailing, the market expects growth. When it is higher, it expects contraction. Peter Lynch, who averaged 29% annual returns at Fidelity, identified the central flaw in the standard ratio. It ignores growth. His solution was the price-to-earnings to growth ratio, or PEG. You calculate this by dividing the price-to-earnings ratio by the expected annual earnings growth rate. A company with a ratio of 20 growing at 20% per year has a PEG of 1.0. Lynch considered values below 1.0 attractive and those above 2.0 expensive. This formula is powerful because it forces you to ask how much growth you are actually getting for the multiple you're paying, preventing you from overpaying for stagnant companies. In 2010, Coca-Cola and Visa both traded at a price-to-earnings ratio of approximately 19. By that metric alone, they looked identical. However, the PEG ratio told a different story. Coca-Cola was growing earnings at roughly 7%, giving it a PEG near 2.7. Visa was growing at 25%, giving it a PEG below 0.8. From 2011 through 2019, Coca-Cola delivered a total return of 103%, while Visa delivered 874%. The price-to-earnings ratio said they were the same, but the PEG ratio correctly identified that one was a mature dividend payer and the other was a platform for compounding. Applying this to today, NVIDIA's PEG ratio sits near 0.62, well below Lynch's 1.0 threshold. Its trailing ratio of 31 is divided by a consensus 5-year growth rate near 50%, driven by artificial intelligence demand. By contrast, Apple's PEG ratio near 2.5 reflects a ratio of 38 against expected growth of roughly 15%. The PEG ratio reframes the entire comparison. NVIDIA looks cheap relative to its trajectory, while Apple looks expensive relative to its more mature profile. The PEG does not provide an absolute judgment, but it adds the vital growth dimension that the raw price-to-earnings ratio completely omits. Next, we have the enterprise value to EBITDA ratio, which answers what it would cost to buy the entire business free and clear. Enterprise value starts with market capitalization, adds total debt, and subtracts cash and equivalents. This captures the full price an acquirer would pay. EBITDA, earnings before interest, taxes, depreciation, and amortization, approximates operating cash flow before financing choices distort the picture. This ratio is capital structure neutral, meaning a highly leveraged company and a debt-free peer can be compared fairly. It is especially useful for capital-intensive industries where depreciation is a large non-cash expense, or for cross-border comparisons where tax rates differ. Let's build an example. Imagine a company with a market cap of $500 million, total debt of $150 million, and cash of $50 million. Your enterprise value equals $500 million plus $150 million minus $50 million, totaling $600 million. If that company reports EBITDA of $100 million, the ratio is 6. This means an acquirer would pay 6 times annual operating cash flow for the business. Debt raises the enterprise value above the market cap, while cash lowers it. This is why two companies with identical market caps can have very different ratios. The one with more debt is more expensive to acquire in practice. These multiples vary by sector. As of mid-2025, the information technology sector traded at a median ratio near 27 to 28, reflecting asset-light models. Consumer discretionary sat near 17 to 20. Utilities, despite their stability, traded near 13 due to heavy capital expenditure requirements. Energy sat near 7 to 8, the lowest of any major sector, reflecting commodity volatility and terminal demand concerns. You cannot compare a tech company's ratio to an energy company's ratio. These metrics only work within peer groups operating under similar structural conditions. Always ensure you are comparing apples to apples, or in this case, tech to tech. The price-to-book ratio divides market capitalization by total shareholders' equity. Book value is what remains if a company liquidates all assets and pays all liabilities. For banks, insurers, and industrial conglomerates, this is a meaningful floor because their assets are tangible. Berkshire Hathaway trades at a price-to-book near 1.5. Warren Buffett has stated that Berkshire will repurchase its own stock when it falls below 1.2 times book value, signaling it is undervalued. For financials, a ratio below 1 can indicate distress or hidden problems, but for healthy institutions, it can signal a major opportunity. However, this metric has a massive blind spot. Apple's price-to-book ratio stands near 43. To a traditional value investor, that figure is terrifying. But it doesn't mean Apple is overvalued. The metric has simply broken. Apple's balance sheet carries its cash and inventory, but it does not carry its brand, its ecosystem, its installed base of over 2 billion active devices, or its network effects. For asset-light technology and pharmaceutical companies, book value captures almost none of what creates economic value. This ratio works for railroads or manufacturers, but it fails for companies whose primary assets are intangible, like intellectual property and human capital. Free cash flow yield is perhaps the most honest metric in investing. It is calculated as free cash flow divided by enterprise value expressed as a percentage. Free cash flow is cash from operations minus capital expenditures. It is the cash left over after the company maintains its asset base. Unlike earnings, free cash flow cannot be manufactured through accounting choices. A company might book revenue early or adjust depreciation schedules to flatter net income, but they cannot fake a cash deposit. Because of this, free cash flow yield is one of the hardest metrics to manipulate and is highly reliable for comparing real economic returns across different companies. Historically, the S&P 500 has traded at a free cash flow yield between 4 and 5%. Value-oriented indices like the Russell 2000 Value typically show yields of 6 to 8%. Research by James O'Shaughnessy found that stocks in the top decile by this yield have historically outperformed the market by 3 to 5% annually. Screening for yields above 7% is a common starting point for value investors. However, a high yield alone is not enough. It can signal a dying business or a cyclical company at peak earnings. Always combine this with quality filters, such as a Piotrowski F-score above 5, to avoid value traps. Consider General Motors, which trades at a free cash flow yield near 1.4%. At first glance, that looks like severe overvaluation. But in context, it reflects the intense capital requirements of auto manufacturing. GM invested over $20 billion in capital projects over the past 2 years and expects to spend $10 to $12 billion annually through 2027. Free cash flow is suppressed by massive reinvestment in electric vehicles and battery capacity. Ford Motor Company generated only $3.5 billion in cash flow in 2025, despite $50 billion in total liquidity. In capital-intensive industries, low yields are a permanent feature of the business model, not a temporary drag. So, which ratio should you use? Each answers a specific question. Use price to earnings for a quick, widely understood snapshot, but avoid it for companies with heavy reinvestment or losses. Use forward price to earnings when you care about future growth. Use the PEG ratio to compare growth companies against mature ones on equal terms. Use enterprise value to EBITDA when debt levels or cross-border taxes matter. Use price to book for banks and asset-heavy industrials. Finally, use free cash flow yield when you want the hardest-to-fake measure of cash generation. No single ratio tells the whole story. The art is in choosing the right lens for the company in front of you. Be careful of 3 common traps. First, the cyclical trap. A steel company at a price-to-earnings ratio of 5 may look cheap, but earnings are likely at a peak and about to collapse. Second, the accounting trap. EBITDA adds back depreciation, but for a railroad, depreciation is a real economic cost because assets must be replaced. Third, the sector comparison trap. Comparing Apple's ratio to ExxonMobil's is meaningless because their competitive dynamics differ entirely. Ratios only work within comparable peer groups. If you ignore these rules, the numbers on your screen become dangerous noise rather than useful information. To synthesize, a stock is cheap not when its price is low, but when the ratio of price to fundamental value is favorable relative to its own history, its peers, and the market. Start with the business model. Is it asset-heavy or asset-light? Choose the ratio that fits. Compare the result to the company's 5-year average. Check if the PEG ratio confirms your price-to-earnings signal, and verify that the free cash flow yield aligns with your earnings metrics. Ask whether the current multiple price is in a future that is plausible or speculative. Remember, Cisco's ratio of 201 in 2000, priced in a future that even massive growth could not justify. Let's recap our toolkit. The price-to-earnings ratio tells you what the market pays for a dollar of profit. The forward ratio adds the growth dimension. The PEG ratio normalizes that growth for cross-company comparison. The enterprise value to EBITDA reveals the full cost of acquisition, including debt. The price-to-book ratio anchors valuation for asset-heavy businesses, and the free cash flow yield measures the actual cash return you receive. Together, these form a complete system. The goal is not to memorize formulas, but to understand what each ratio reveals and what it hides. Remember, valuation is not just a calculation. It is a judgment informed by numbers. In our next episode, we will move from market multiples to intrinsic value. We are going to build a discounted cash flow model live, using weighted average cost of capital, beta, terminal value, and a full spreadsheet. When your ratios tell you a stock is expensive, the discounted cash flow model will tell you what it should actually be worth. This is the gold standard of professional analysis, and you will learn how to do it yourself. Join me for episode 12, and we will take your fundamental analysis skills to the next level. See you there!